the odds are getting raised that they might actually go 50, a double. It's not past 50% at this point, but that there's pressure on the ECB, and we know there's a global impact here and a global. We've shared the inflation problem, especially with economies like England and like the ECB. Guys, this is the one day where I don't have to wish that I'm in Congress to question the Fed chair, because next week I've got a great opportunity. I'm going to sit down for a policy panel with Fed Chair Jay Powell, with the head of the ECB, Christine Lagarde, with the head of the Bank of England, and with the head of the Bank of Japan. It's basically a dream team.
Wow, I'm giving you a wow on that one, Sarah.
I know. I'm trying to one-up you on Elon.
Well.
Just kidding. Jim already did that.
Keep trying, but that's very impressive.
No. I think there's a lot of questions.
Of course, will you be able to deliver is the key question.
Exactly.
Will you be able to get them to all admit to all their failings?
Right.
Yeah.
That's not what I'm going to try to do. What I'm trying to do is find out what path they're taking, because they're taking different paths. Bank of Japan hasn't even tightened yet. They're not even fighting inflation. They're welcoming it. Fed Chair Powell is pausing, and the ECB and the BOE are going forward. And they've all got inflationary issues.
What is going on, guys? What's going on? Hey, Regine, what's going on? Alex, what's going on? Richard, let me know if you guys can hear me. You should be able to hear me just fine. Actually, let me check my mic. I set this up really quick because I didn't realize that Jerome Powell was actually going live until just like half an hour ago. And I had already said to myself, I missed the opportunity to go live because it takes time to kind of set this stuff up. But then I saw that he was late. So it actually, I was able to set it up really quick. So happy to do that for you guys. We're going to be covering what Jerome Powell is going to be saying. Now, this is the House Financial Services Committee, I believe. And so, he's the question here is, how much is he going to deviate from what he already said last week? I do want to hear them grill him on, grill him on the question of why are you going to pause if you are saying that you now are that you're going to be entertaining rate hikes in the future. Now, you guys know where I stand on this. And if you're joining me for the first time, welcome. But for those of you that are regulars, you know where I stand on this. I don't think that Jerome Powell and the Fed are going to raise anymore. I think the rate hike that we saw, the last rate hike that we saw, is going to be it. I don't think that they're going to raise anymore. I thought that the pause was a bit premature just because if you look at history, the Fed doesn't tend to pause until the Fed funds rate is above both CPI and core. It is above CPI. It is not yet above core. But if you look at historical pauses, the Fed funds rate is always above CPI and core CPI before the Fed pauses. But I personally don't think that they're actually going to be pausing. I mean, going to be raising rates after they pause. So just a little bit more background about what this is. It says Federal Reserve Jerome Powell testifies before congressional lawmakers this week, starting Wednesday morning with the House Financial Services Committee, just 1 week after the central bank paused. In prepared remarks released before his testimony, Powell doubled down, which is part of the reason why the market right now is down. The NASDAQ is down 1.15%. But if you have actually been watching my videos, you know that we were expecting a summer correction or summer pullback after that insane bull market rally. And we actually hedged for it last week. Let's hear what Jerome Powell has to say, and then we'll jump back.
I continue to pound the table. I would say on a tactical basis, I continue to pound the table that what we're seeing, if everybody's worried about tightening monetary policy, that has to be a good time to be a lender. You can't have it both ways. Like if conditions are tightening around from the banks and from the Fed, then being a lender is a great place to be. But I do think equities perform. I think Japan's going to continue to break out.
So I'm gonna wait for him to start talking because this CNBC guy is talking. This guest on CNBC is talking still. And Jerome Powell hasn't started, but he did get a fresh haircut, and he's going no glasses today. I mean, he might put on his glasses when he starts reading. But Yeah, so we did start hedging last week in the academy. When I sent out my weekly analysis last week, I said this is the time to start thinking about hedges. And there are reasons for that. Obviously, there are technical reasons for that. There are fundamental reasons for that as well. But so far, those hedges are working out well. So let's see what Jerome Powell says today. Is he going to say something extremely different from what he said last week? Is he going to try to soften his tone? Is he going to try to harden his tone? I think the market in the short term will be paying attention to that very much so. So let's see. Hassan says he looks mad. Yeah, you know what? He definitely looks angrier than I've ever seen him. Surprise, surprise, they're late. Actually, you know what? He's always on time, but when he's dealing with he's always on time during the FOMC releases. But when he's dealing with the government, you're right. I guess he is late. Reno, what's going on? Glenn, what's going on? Abel, Kenan, you're in Canada? Oh, dude, you need to make a pit stop, man. I didn't know you made it to Canada already. And I responded to your text, by the way, but I didn't hear back from you. Give me those dates. All right. Hazy, what's going on? Richard, Alex, pretty brown eyes. What's going on? Lyle, wow, you don't make it a secret what you think about your eyes. Soner, yes, hit the likes. We prepared this in record time, so make sure you hit those likes. We were not planning on going live today, only because I didn't realize that Jerome Powell was going live until very recently. So hit those likes for setting up this live stream in record time. All right, make sure you do that. Greetings from the island of Cyprus. Cyprus is awesome. What's up, JD? Aaron. Producer Pike Fire, what's going on? Ola, what's going on from London? What's going on? Rhodes, hey Z, Jerome isn't mad, just stressed. I mean, look, he's combing through these notes like they're not the same old notes that he's had for a year. I don't know. What if he just comes out and is ready to risk it all? What if he just comes out and, like he's getting ready to retire? He's 100 millionaire. What if he just is just ready to take the economy down with him before he retires? Oh, wow. Tony Hale. Yaati Abini from the Navajo Nation. Oh, my God. This is how diverse our group is. Someone is calling from the Navajo Nation. That's amazing. He put glasses on, getting even more mad. Yeah, he definitely looks angry, right? Like, we need a body language expert. But he definitely looks angry. Jerome Volker Power. Yeah, we'll see. Danny Samuel D. Money, what's up? Marcus, what's going on? Greetings from Seattle. What's going on, man? Go Hawks. You know what, Marcus? I live, I'm from LA. I live in LA, and we have two basketball teams here. One of them is owned by someone from Seattle, right? Stephen Ballmer owns the Clippers. I've always said that the Clippers need to move to Seattle, and they need to just turn that team back into the Sonics. Like, why the hell Seattle doesn't have a basketball team is beyond me. And nobody here cares for the Clippers or Steve Ballmer for that matter. So they need to move the Clippers back to Seattle and then just turn them into the Sonics. What do you think? Good morning. What's going on, Mike? Daryl, he looks like Thanos before the snap. Hello from Southern California, high desert. Lizard breath says, wow. Are you a lizard, though? He's pissed no one listened to his hawkish statement. I don't know. Have you seen the market? You saying no one listened to have you seen the market since then? The market has had 3 red days in a row. When has that happened? That has not happened since April. No, since May, early May, right? So we've had 3 days in a row. 4,500 was my target. We got to 4,450. we almost got to 4,500 on the S&P futures. We got to 44.94, but yeah, on SPX we got to around 44.50. But that was my target for if and when Jerome Powell pauses. And then, you know, there's a huge technical level here, right? You have this huge consolidation level here. You have this huge imbalance up here. And, you know, plus with June OPEX expiring when it did, in my view, there was a runway for, you know, for a July, August pullback for sure. Okay. They just went on break, I guess. Oh no, there they are. I mean, they need to start this already. Here we go.
To the lows of the session net right now, down about 1% or so. This is coming on the heels of the Federal Trade Commission.
Oh, this has to do with Amazon. FTC files lawsuit against Amazon related to Prime enrollment practices. All right. I don't want to miss it, so I'm trying not to deviate too much from this, but if you guys have any questions on any charts or anything, let me know. Bring him back. Yeah. See, Marcus, I'm with you, man. I'm here in Seattle, Liston says. See, I'm rooting for y'all. Thanks, Z, for all you do. Appreciate you, J. Cole Spartan. Oni Lotus says, go Hawks. They don't like Ballmer down there? No, nobody cares for Ballmer or the Clippers down here. You know that in LA you can buy Clippers tickets off of Groupon. Like Lakers tickets are sold out regardless of who's playing. Even after Kobe retired and we had, you know, no superstars on the team, like Lakers tickets still sell out on a nightly basis. Just like the Knicks, right? It's just such a big city, but you can, like, even when the Clippers had two super teams, right? Like the Chris Paul, Blake Griffin team, and then the Kawhi Leonard, Paul George team, like you could still find Clippers tickets on Groupon on a nightly basis, which is crazy. Coming at you from stinky Portland. I hear imbalance. Are you trading ICT? I've mentioned this in our free mastermind that we did over the weekend, which was an amazing turnout. 1,500 of you joined the wait list, and that recording has been sent out. But I went over my exact trading strategy. So do I trade ICT? No, not strictly. There are ICT concepts that I do like, and I think work really well for the style of trading that I do. My problem is that I think when you stick to a very strict strategy, especially one that has a big cult following like ICT, one, I see, you know, people who are really fans of that put down other people who trade in a different way. And then also I think that you might tend to miss opportunities if you are just focused on one strategy, right? So for me, there are a couple of things that I like. Obviously, the concept of liquidity has been around long before, but the way in which it is presented in ICT theory or whatever you call it, strategy, I think makes a lot of sense. And I like the way that liquidity is presented there. So credit where credit is due. And I do really like the concept of measuring imbalances by fair value gaps, right? I do think that it is a great way to measure imbalances. But I always say this, I'm not the best person to ask about ICT strategy because I'm not strictly an ICT trader. I just like a couple of the concepts, right? Just like I like VWAP, just like I like Fibonacci levels. Over the years, the package in which I choose to trade, really, I throw away stuff that doesn't make sense to me, and I retain things that make sense to me, right? And those two concepts from ICT definitely make sense to me and are conducive to the way that I trade. So, yeah, and in short, no, I don't trade ICT, but I do take a couple of concepts and use them in my own trading. Hopefully that makes sense. Miguel Escobar. What up, Z? ¿Cómo estás? Smash the like button. Yes, smash the like button. Powell speaking. Is he? Where? No. Moments away. Fed Chair Powell Q&A. What are you talking about, bro? Pretty brown eyes. What are you talking about? Yahoo Finance? All right, let's see. It's on CNBC. It says moments away. All right, let's see. Sorry.
Somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. With inflation running well above our longer-run goal of 2% and with labor market conditions remaining tight, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5 percentage points since early last year and have continued to reduce our securities holdings at a brisk pace. We have been seeing the effects of our policy tightening on demand in the most interest rate-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. And the extent of these effects remains uncertain. In light of how far we have come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the FOMC decided last week to maintain the target range for the federal funds rate at 5 to 5.25% and to continue the process of significantly reducing our securities holdings. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, we will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and inflation economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability, again, is essential to set the stage for achieving maximum employment and stable prices over the longer run. Before concluding, let me briefly address the condition of the banking sector. The U.S. banking system is sound and resilient. As detailed in the box on financial stability in the Monetary Policy Report, the Fed, together with the Treasury and the FDIC, took decisive action in March to protect the U.S. economy and to strengthen public confidence in our banking system. The recent bank failures, including that of Silicon Valley Bank and the resulting bank stress, have highlighted the importance of ensuring that we have the appropriate rules and supervisory practices for banks of this size. We are committed to addressing these vulnerabilities to make for a stronger and more resilient banking system. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman. I now recognize myself for 5 minutes. Chairman Powell, as I laid out in my opening statement, inflation continues to be broad-based and persistent, both of which are concerning. Last week, the Federal Open Markets Committee decided to pause rate increases. And at the same time, the committee alluded that it would raise rates more later in the year. And so how should the FOMC's posture at the June meeting be interpreted? Will the committee continue to raise rates later this year? What's the thinking of this? What are we to understand?
Thank you, Mr. Chairman. So you're right, of course. We did decide to maintain the federal funds rate at its current rate at this meeting. At the same time, participants submitted personal forecasts suggesting that almost all of them thought there would be additional hikes. And I just want to say those two things are entirely consistent. The point being that the level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace. That's really it. You know, we were at 75 basis points for several meetings, then we were at 50 basis points, then 50 basis points, 25 basis points at 3 consecutive meetings, and now we're moderating that pace, much as you might do if you were to be driving 75 miles an hour on the highway, then 50 miles an hour on a local highway, and then as you get closer to your destination, as you try to find that destination, you slow down even further.
Okay. So it is more data is necessary for the Fed to make these decisions, and that's one interpretation, but thank you for a broader view there. I also want a broader view on this question of the vice chair for supervision is performing his own personal holistic review of the Fed's regulatory framework for bank capital and liquidity. In an interview yesterday, he discussed some version of a new type of stress test even, striking complete confusion in his description of it. And at the same time, we have testimony from you, even from the vice chair of supervision, saying that we have a sound banking system that is well capitalized. You will sit in judgment of this proposal that the vice chair for supervision will bring to the full board on this holistic review of capital. There are a lot of discussions about the amounts of capital he's talking about, the concern that this is pro-cyclical at a time where our economy with higher rates is you're measuring what's happening in the broader economy, and at the same time we're going to have a major piece of capital required by financial institutions, which will further restrict lending. So how can you tell us to think about that, given your seat on the Open Markets Committee and as a Fed governor? How would you interpret that?
So I guess I would say you're right. There are a significant number of proposals that are kind of in the works. They haven't been finalized, let alone brought to the board yet. And so I can't really get into specific details today.
Well, we'd like your thinking, Chairman Powell. That's what we'd like.
What I can share is, principles and how I will think about this. Regulatory proposals go to the board. Every person on the board, that's 6 governors now, has an obligation to evaluate and vote on those, and I'm one of those people. I also chair the board. So a couple things I would point out. Just first that, I think regulation should be transparent and consistent and not too volatile, and particularly as it relates to capital requirements. I do note the central importance of capital. We want banks to be resilient to shocks. We want them to be able to lend in good and bad times. We want, in particular, the GSIBs, the 8 largest banks, to have very high levels of capital and liquidity. Indeed, we spent years raising those levels over a long period of time. And I think there's broad agreement, as you point out, that capital is strong. And, the question there will be what sorts of increases will be justified. That's what we'll be looking at. The other thing is to point out the trade-off between higher capital. The benefit of it, of course, is to have stronger banks that can lend and maybe survive more kinds of crisis environments. But, there are costs as well. And I think it's going to be, as always, a question of weighing and balancing those costs. And that's what I'll be thinking about. The last thing I'll say about that is just we benefit from having banks of all different shapes and sizes in our system. And we want to be careful not to regulate the smaller banks to the point where really their business models are challenged for all but the largest banks.
Well, this committee would expect to see a quantitative analysis of whatever the capital charge is going to be. We would expect that from the Fed, as we do from other regulators. With that, we'll now recognize the ranking member of the full committee, Ms. Waters, for 5 minutes.
Thank you very much. Chair Powell, at this committee's last hearing on digital assets, my Republican colleagues proposed a stablecoin bill that would create 58 different licenses with federal regulatory approval over only 2 of the licenses. The remaining 56 licenses can be issued by each state, territory, and D.C. with little or no federal oversight, regulation, and enforcement. This proposal takes state preemption into a whole new level. It effectively allows every state to preempt another state. DC-based coins, for example, would be sold to individuals nationwide, and New York or North Carolina regulators could do nothing to protect their own residents, while even the Fed would be severely hamstrung in providing any oversight. I've argued that we should allow states to be part of this process, but we must have a strong, enforceable federal floor with a role for the Federal Reserve to approve and provide oversight of payment stablecoins issued by non-banks in order to ensure that consumers are protected. Such a framework is similar to our dual banking system, and it would ensure that non-banks and banks are treated the same. We should also bear in mind that payment stablecoins are a new form of currency intended to allow individuals to pay for things with them. As such, do you agree that it is important for the Fed, as our central bank, to have a chance to approve or decline any state licensed non-bank entity before it starts issuing payment stablecoins nationwide?
First of all, let me say we appreciate that we've been able to offer our views on these things to your staff and also the majority staff, and we appreciate the consideration that's given to our views. We do see payment stablecoins as a form of money, and in all advanced economies, the ultimate source of credibility in money is the central bank, and we believe that it would be appropriate to have quite a robust federal role in what happens in stablecoins going forward, and that leaving us with a weak role and allowing a lot of private money creation at the state level would be a mistake. But nonetheless, again, I do appreciate that we've been able to be heard and share our views with the committee.
Well, thank you so very much. I am appreciative for that clear answer. The next question that I have for you is a bit unusual. But one of the reasons we push diversity is because those things that have not been discussed, issues of people of color, etc., have not been dealt with. I'm going to throw you something that you would not expect. Earlier this week, our nation celebrated Juneteenth, which Congress recognized as a national holiday for the first time since 2021. The holiday celebrates the day enslaved African Americans in Texas heard that they were free, 2.5 years after the Emancipation Proclamation was issued. To this day, Black Americans grapple with enduring racial economic inequality that has its roots in slavery, as evidenced by the black-white gap in net worth and home ownership rates. My bill, the Federal Reserve Racial and Economic Equity Act, would require the Federal Reserve to carry out its duties in a manner that supports the elimination of racial and ethnic disparities in employment, income, wealth, and access to affordable credit. Now, the Fed has a number of duties to pursue maximum employment in the monetary policy, to supervise banks for compliance with our fair lending laws, and to ensure the Community Reinvestment Act is administered in a way that puts an end to discriminatory redlining practices by banks. Do you agree with me? And Atlanta, Federal Reserve President Raphael Bostic, among others, that the Fed has a role to play in addressing racial economic inequality as it carries out its work until Congress passes this bill? What steps will the Fed can you take to address racial and economic inequality?
So we do consider inequality in the economy as part of our thinking about decisions, but ultimately, and those are certainly highly valuable social goals to pursue. I would say our ability to take part in addressing those issues is fairly limited. We have one federal interest rate that we set. We do try to keep in mind, as you know, not just the aggregate national level of unemployment or employment, but also that for different ethnic groups. So we take that into account, but I would think, and I think that's just part of making sure that we feel like we have all Americans in the room with us when we're making decisions on monetary policy. I will say, though, I think other agencies are better suited to address these deep issues.
Thank you. We must have this continued discussion on racial equality. I yield back.
The lady yields back. We'll now go to the Vice Chair, Mr. Hill of Arkansas, for 5 minutes.
I thank the chairman of the committee, and Chairman Powell, great to have you back before the committee. And this morning, you've reiterated, and certainly Vice Chair Barr has reiterated a number of times, that the banking industry here in the United States is well capitalized. And in fact, capital levels have remained robust despite COVID-19, with a 20% plus unemployment rate increase and a 9% output gap. They've remained stable through government shutdowns. They've remained stable through severe stress testing. And maybe more importantly, just in the last few months, since the first week of March, you've seen strong capital come into play as we've grappled with the reality of a 40-year increase in short-term interest rates and that impact on banks. But as the chairman said, Michael Barr continues to say he wants to increase capital requirements on certain financial institutions. And in March, you testified that you said, I will do everything I can possibly do to bring people together, meaning on the Board of Governors, in consensus and have a capital framework that could be broadly supported. So to what extent have you and the other governors been involved in this so-called holistic review by Vice Chair Barr? Has he briefed the other members of the Board of Governors thus far?
Yes, and we've all been briefed by staff, really, on the proposals, but as I mentioned, they're still somewhat in motion. But yes, we've been briefed.
So you would say those proposals are still under consideration and that there's no final decision that's been taken by the board?
No, well, no. Once the proposals really do settle down and are written up, they'll come to the board for a full discussion and a vote.
Has the Fed board reconstituted now the Committee on Supervision and Regulation, the membership of it?
Oh,
who's on that committee now?
So that committee is chaired by Vice Chair Barr, and it also includes Governor Jefferson, and it includes Governor Bowman.
When you look at capital in the U.S., and I look at the globally significant banks here versus other places in the world, would you say that the U.S. banks, the U.S. G-SIBs, are better capitalized than their global peers in Europe or in Asia?
So we're certainly at or near the top of the league table. I think there are a couple other jurisdictions that also have broadly similar levels of capital strength. But yes, we're at the top of the league table.
I looked at it this morning, and U.S. G-SIBs have 11.3% capital without any kind of modification compared to their European competitors at only 9.9%. So would you say that we're better capitalized than the European banks, the European G-SIBs?
I hate to call out the other jurisdictions, but I would say our banks are very strongly capitalized and also competing quite successfully globally outside the United States.
Yeah, I agree, and I think we've strengthened capital, we've strengthened our supervision, notwithstanding the problems that we saw this spring, which we've talked about ad nauseum here. But that capital standard does make American banks, I think, stand out. And wouldn't Basel, the so-called Basel III holistic reforms, wouldn't it be better if the
All right, so far we haven't really gotten anything new from Jerome Powell. And if you take a look at the market and you'll see that it hasn't really moved, right? So Jerome Powell started talking at 10 a.m., which was this candle here, right? And the market has stayed in this range since he started talking. This looks like a bear flag, if you're going by traditional patterns. I do think the market was headed down anyway before Powell, and I think the market is just waiting for Powell to either say something that sounds remotely dovish, or the market will likely continue as is, right? As I said before, I do think from a technical perspective, there was a reason for the market to start pulling back here after hitting near 4,500 following the pause. So, you know, this is a shame, guys. There's like 1,000 of you here and only 152 likes. Don't you guys want people to find good information? Hit that thumbs up. Hit that thumbs up. All right, hit that thumbs up. You guys need me to incentivize you every time to hit that thumbs up? No, hit that like button. Hit that like button. Maybe I should do what everyone else does and you know, do a giveaway every stream so that you guys can hit that like button. But you can see that the market has stayed in this range. I do think the market was heading down anyway. This is the NASDAQ. We could take a look at the S&P 500, and you could see the same thing, right? Like since 10 o'clock, we've had just the same range with these wicks. This is untradeable. This is why, you know, in the Academy this morning, I said, you know, keep in mind, Jay Powell talks in 10 minutes. I'm going to wait until he's done before looking at day trades, because it's just not worth it to trade this kind of chop here. Whether you're long or short, you're going to get stopped out if you have, you know, optimal stops there. So that is why I actually have not entered any trades yet. I'm just going to wait until he's done, see if we get a continuation, or if this right here is going to constitute the low of the day, and then we get a move up. We'll see. NASDAQ is currently down 1%. S&P is down 0.43%. The Russell looks like it's actually pretty stable. The only problem with the Russell is a lot of times you do get a ton of wicks, and it is hard to trade on some days, and some days it does offer really easy trades. Someone was asking me about ZT and whether I would re-enter. No, I'm not re-entering ZT yet. I think there is a generational opportunity to enter ZT and to a lesser extent ZN soon. But the reason that ZT hasn't skyrocketed yet is because of the fact that bond yields continue to rise. And bond yields continue to rise because of the fact that the bond market is not yet believing that this might be the last rate hike, right? So bond yields are rising because there is a fear that the Fed is actually going to get aggressive, you know, soon. But the minute that the bond market is convinced that Jerome Powell is done raising rates, then I think you will start to see those yields slam. But that time is not now, and I think we do have a lot of time for that. Let me see if you guys are asking questions. Nihad, that is not the way you ask a question by posting it 10 times. All right, so unfortunately, I'm going to have to ignore you for now. Juan Buffett. What did Juan Buffett say? Powell's a Bud Light kind of guy. It's Modelo time. You guys know that Modelo and Bud Light are owned by the same company, right? They're both owned by Anheuser-Busch. We're waiting for good news. Antonio Sandoval says, hat. I still need a hat, says Sonar. Give us plays so we hit the like button, Tanvir says. Wow, couldn't be a more annoying person. That's all you want? You just want plays? All right. Here, I'm going to give you a play, but this is only for Tanvir. Tanvir, just buy calls. Buy as many calls as you can on QQQ expiring today. All right? Nobody else take this but Tanvir. I'm just messing with you. The place to sit still, yeah. Wait until Jerome Powell's done talking, right? And the market to stabilize. I mean, the market's only been open for an hour and 15 minutes, so we will have time. I do think this looks like a potential continuation unless Powell does say something that's dovish. We can go back and see what he's talking about, but recently he's been just answering really BS questions, nothing to do with with Fed policy.
Reporting what they heard from back in
How often were you meeting with Vice Chair Quarles?
I reasonably frequently. We sat quite near each other.
And never discussed the cultural shift?
I didn't say that, but I don't remember it. The way you're describing it is not what I recall. I recall Vice Chair Quarles talking about things like focusing on the really important issues and not getting diverted into other.
So the way it was described by Vice Chair Barr is not what you recall.
Well,
who's asking him
what
questions?
no part in.
She sounds like Charo. Who is this?
I'm confident that the staff who worked on the report reported accurately what they heard. I'm sure that that's right.
So what steps did you take proactively to meet with regulatory and supervisory staff?
Well, I think we're taking significant steps now. We're, as you know, under Vice Chair Barr's leadership, we're looking carefully at these events and asking ourselves, what do we need to do with supervision? And I think there is a point to be made that there are situations in which we need to be more forceful and more proactive. Not in all situations, but in some. In regulation, I think we're learning that we need to update our thinking around liquidity regulation, which was based on a certain speed of bank runs, which now looks to be outdated.
My time has expired.
The gentlelady's time's expired. We'll now recognize the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. I just want to start off by asking a few yes or no questions. Was the Silicon Valley Bank failure a result of a liquidity issue?
I'm sorry.
Was Silicon Valley Bank failure a result of the liquidity issue?
Good question.
Among other things, yes.
Signature Bank failure, the result of a liquidity issue?
Yes, I mean, that's not, there's also a lot of very bad management decisions being made here.
But liquidity. First Republic, was that a failure result of a liquidity issue also?
Among other things, yeah. I mean, I wouldn't say just liquidity.
Well, all right. Were any of them a failure of having too low capital levels?
So let's go to Silicon Valley Bank. The issue that triggered the run initially was the presence of significant losses in their securities portfolio.
Yes.
And that is that is a capital issue.
So they had too low a capital, the requirements. So what
they weren't required to, as you know, they weren't required to take that into account in their capital. But I think if you remember, what people were focusing on was these portfolio losses, and then what people weren't focusing on was the fact that they had in excess of 90% uninsured deposits, and that's what caused the run.
So would increasing capital requirements for Silicon Valley Bank or any of these other banks or all banks together, would that have stopped these banks from failing?
That's a hypothetical, unknowable question. I think it might have helped. I think it might have helped, but
how much then? Increasing it by how much would have helped?
It's very hard to say. Very hard to say. I mean, clearly the main issue there was a failure of management to follow up, a failure of supervision to require them to follow up, and really the liquidity regulation was just not appropriate. We needed to have stronger regulation around liquidity and uninsured deposits.
So last year you said the banking system is very strong, well capitalized, highly liquid, does a much better job of understanding the risks that it runs and managing them. And just today you said the banking sector seems to be strong. Do you still stand by those statements? I mean, just said it today.
Yes.
So, yep. Last month, Vice Chair Barr appeared before this committee, and he agreed with you and said overall banks have a strong capital and liquidity. Secretary Yellen has said similar things. But today, even though you've all said that banks seem to have strong capital, you seem to lead us today by saying the bank's considering what increase would be appropriate of capital requirements. So has the board already decided that an increase will happen? They're just deciding what's the size of the increase for capital requirements?
No, what I meant to say, what I thought I said was that any increase above these levels would need to be shown to be justified.
So I understand, and you have a vote as whether or not what this proposal you'll vote on whether or not. Do you personally think that an increase is necessary at this time?
Do I think
that an increase in capital requirements is necessary at this time?
Look, I'm going to react to whatever the proposal turns out to be in the end and give it my best assessment. And also, I'll, that's what I'll say.
Okay. You just also said that credit is tightening. Won't increasing capital requirements further tighten credit?
Over time, I mean, the thing about capital requirements is if we put a proposal out this summer, let's say, it'll be quite a while before that proposal is,
I'll explain it
agreed in among the agencies and then voted on, and then it'll take some years to come into full effect. So I would think, whereas interest rates, for example, have immediate effects on financial conditions and then reasonably quick effects on economic activity, capital requirements are a much more sort of medium-term, longer-term thing.
So I'd like to move on to what the impacts on raising capital requirements would have. According to an academic literature by the Basel Committee on Banking Supervision, a 1% point increase in capital requirements could potentially reduce annual GDP by up to 16 basis points, showing that higher capital requirements come at a cost and could have significant impact on the U.S. economy. I discussed this with Vice Chair Barr last month, and expressed my concerns about what the impact of increased capital on the real economy, but he didn't answer the question directly. We just need to, we're hearing from all sorts of industry that these increased capital requirements at any level would have a further tightening on lending. And if that happens, and I'm hearing from everybody, if that happens, it's going to be a real disaster. So I think anything that the committee proposes, if you could come back and brief us on before it's finalized, we would appreciate that very much, sir.
Gentleman's time has expired. The gentleman from Missouri, Mr. Cleaver, is now recognized.
Thank you, Mr. Chairman. Welcome, Mr. Chairman. Thank you very much. This is probably Economics 101, but a lot of people in my district are misunderstanding 101 along with me. In May of this year, unemployment remained at 4% for the 16th consecutive month, and at 3.7%. This means that unemployment remained at or below.
Wow, that guy is struggling to get his question out. So let me explain what just happened. Modelo is owned by Constellation Brands in the USA. Yes, and Anheuser-Busch outside of the USA. So there is a proposal regarding capital requirements, right? The amount of capital that banks are required to keep on hand. There's a proposal to increase that, right? And Powell is actually being very quiet as to what his personal opinion is, because he gets a vote and he actually chairs that committee. So not only is he the chair of the Federal Reserve, but he's also the chair of the committee that gets to decide on capital requirements for banks, right? So since the pandemic, not only have reserve requirements been taken to zero, meaning banks don't even need to keep any money of your deposits, right? It used to be that there was a reserve requirement of 10%, meaning if you deposit $1,000, the bank needs to keep $100 and they can loan out $900 of your money. But now, since the pandemic, that was taken to zero. So if you deposit $1,000 at the bank can loan out $1,000, right? So not only have reserve requirements been taken to zero since the pandemic, but also capital requirements have been reduced in order to provide liquidity to the economy. But now, since obviously interest rates have been going up, and loans are harder to pay, we obviously have, record credit card debt. Corporate credit looks pretty high, as well as, commercial real estate credit. We've seen a liquidity crunch and a credit crunch, meaning banks are less likely to loan money out. Now, when banks are less likely to loan money out, over time, that creates a contracting event in the economy, meaning the economy contracts because there's less liquidity. And so there is a vote coming up. I will have to look into the details of when. And Jerome Powell is chair of that committee. And the previous gentleman had asked him about, what is your take on the capital requirements? What is your vote, basically? Are you voting to lift capital requirements, or are you voting to keep them as is, right? Now, this is important because obviously with banks, with banks less likely to lend now and interest rates up, if they raise capital requirements on banks, that is going to further hamper banks' ability to lend, which means that the credit crunch will get even tighter. So as you have high rates that are going to be paused for quite a long time, I think they'll be paused until at least the end of the year, meaning we won't see a cut. If banks are less likely to lend and capital requirements are now even raised further, then I think that can worsen the credit crunch situation and we can fall into a recession quicker than we thought. So that was actually a very good question, probably the best question that we've heard so far by someone who's actually paying attention to the monetary policy that the Fed controls, right? Like asking Powell about income inequality and stuff like that. Of course, those are things that are important socially, but those are really things that politicians should be debating amongst themselves and coming up with policy, right? Like politicians work for us or are supposed to work for us. That's not Powell's job. Powell's job, his job is only to control monetary policy as it relates to the Fed and the banks. He can't do anything about income inequality, right? That's not his job. So it's always funny to me when politicians are asking him about social issues, which they themselves are failing on, right? Regardless of where you fall socially, whether you're more liberal or conservative, it doesn't matter. That the fact that politicians are asking him that question is ridiculous in and of itself because it's their job, right? Not his job. So anyway, that's a tangent. But you bounce off the fib and hit the prior low. Who's Manic Mike talking to? I haven't taken a trade yet. Maybe you're talking to someone else who's trading. Guys, there's 342 likes on this stream. There's 639 likes on the Fed stream. All right. The Fed should not be getting more likes than us. Make sure we at least match this number here. All right, let's see what's going on with so far with the markets, how they're reacting to this. Yeah, see, as I said, this to me looked like a bear flag, and we will likely get a continuation here. So on the Nasdaq, we did get that continuation. It looks like on the S&P 500, it was not forming a bear flag. S&P looks very, very different to the Nasdaq, by the way. The Nasdaq, this looks like a classic bear flag, right? You have a drop followed by consolidation, right? You have this consolidation here followed by another drop, right? This is a classic bear flag. The S&P 500 so far looks like people will likely take this as a double bottom, but I do think that the S&P 500 does have a chance here to actually drop. Yeah, I do think the S&P 500 here does have a chance to actually drop below these equal lows. If we get back up here, I will likely take a very tight short. Let's see. Yeah, this is giving us a 2-to-1 trade. If we come back up here, I will likely take a very tight short with a stop limit right above VWAP. And then take most profits at the recent lows. But it's so wild that NQ's is really playing out very, very, very differently than ES. Not equal lows? What are you talking about, conscious investing? What is this then? What is this right here? Careful Z? Careful about what? What are you guys talking about? NQ is weaker, ES is stronger. Yeah, of course. Just saying they did run. Yeah, that would be that would be the reason that I would be less likely to take this trade, is because this could be a liquidity run, right? This is so yeah. Is this an A+ trade? No, it's not an A+ trade. What are you talking about, Max Zubik? Be careful. Be careful of what, bro? I'm sitting here just talking about a chart. Y'all are funny. If you don't know what you're doing, you're going to get wrecked. Yeah, that's day trading anything, Rich, of course. Not equal lows. Oh, I already went over that. Those are equal lows, by the way. It can be equal lows and a liquidity run at the same time. Hyder says, watch out. I think people are just fucking with you. Yeah, probably. Probably. Careful, there's spiders on the wall. Let's take a look at Tesla real quick. Oh, Tesla's forming this very ugly H pattern. You don't see this H pattern quite a lot, but it is a super ugly pattern when it forms. The only problem with taking trades like this is these are not A+, because this right here, these right here look like liquidity grabs, right? So if you have a liquidity grab, then the most likely scenario is that you go the other way, right? But this is why you wait for market structure. So if you were really prudent, you would either, in this type of situation, the only way that you could trade this is you'd wait for a market structure break and then a retracement, and then you would take it long, right? Or you would wait for this level to be broken completely, wait for a retracement back up, and then take it short, right? So a lot of people want to bum rush these trades and you know, just preempt them, really. But market structure will really tell you the story. Where do you think S&P will bottom next? I don't like to talk about it in terms of bottom, but I do think there's support, as I mentioned in my video from yesterday. I do think there's support between 4,000 and 4,100. Miguel Escobar, thank you so much for your donation to St. Jude's. Appreciate you, man. Thank you so much. I got to practice that and patience. I mean, yeah, patience for sure. Patience for sure is necessary. AMD getting smoked. Yes, and this is making me very happy. You know why this is making me happy? Do you want me to show you why this is making me happy? I'll show you why this is making me happy. This is making me very happy because your boy has a short on AMD. I took a credit call spread on AMD, the 115-120 call spread that is up 46% now. And I'm going to likely keep this. And this expires in a month, right? I probably likely went out too far in advance in terms of timing. This expires in a month. So up 46% on AMD currently on this 115-120 credit call spread. We just need it to keep dropping. I could take profits on this. But there's a lot of money left. So let's take a look at AMD real quick. Oh, yeah, fill in this gap. I will likely close half of this today. That's an amazing play. Wow, AMD down 5% today. I will likely close half of this today. For sure. Jesse donated $5. Thank you so much, Jesse Steve. Appreciate you. Z, are you going to record your mentorship class? It's already recorded and released. Yeah. It's already oh, you're talking about the personal mentorship? This is actually something that I should bring up. So we are doing a personal mentorship. We are the waitlist spots are filling up. We're only going to be taking 20 or less people for this. Only 20 or less people. We want to make sure that we are giving it to people who actually want to be there. We want to make sure that we are this is going to be taught by myself. I definitely want to make sure that people who are there actually want to take their trading to the next level and are extremely serious about it. No messing around here, right? We're not going to be messing around. We're going to be going over technical analysis, trading, options, futures in detail. It's going to be 8 weeks over the summer, right? And I think that this will fast track your trading, regardless of where you are. This will fast track your trading to another level within these 8 weeks. I'm going to be teaching you everything I know. Class size will be extremely small, and that way we get to answer everybody's questions, and no question will be left unanswered, right? And it will be my personal goal to take the small group to the next level. So if you are interested in this, that link is in the description. Is this going to be recorded? No, unfortunately, it is not. This is going to be recorded for those that are selected to be in this, but it's not going to be recorded and released. No. Yeah. The masterminds will, though. The masterminds will. Byron Mystery, appreciate you. $20 to St. Jude's. Thank you so much. Anonymous donated $10. Thank you so much. Appreciate you. Let's check on ES real quick. Oh wow, what do you know? You already would have netted a 1-to-1 play on this short. So much for being careful. Miguel Escobar, come on. Let's see more donations for the kids of St. Jude. Yeah, appreciate you. Tyler, just click the link, bro. I'm not going to answer any questions here about pricing or anything. Mark B, just click the link. Put your name on the wait list. There are Clippers out to get you now. What do you mean? Clippers? Not sure what you mean. I've been bum rushing trade since 86, season Curlies. Wow. That's before they even had computer trading, really, for retail at least. The diversity of your trading style is unique. Yeah, appreciate you, man. It really is. I mean, it like I said, it's not, conscious investing. It's not random. It took me 20 years, but, and I learned something new every day, but over the years, I found a strategy that works for me, my style of trading. And it spans a variety of instruments, right? Whether we're talking about single options or spreads or double calendars or futures, I don't think that there's a group that offers the variety of trading like we do. Oh, wow. What an amazing short. You're welcome. If you entered the short, I would exit right now. Hit the profit target to the T. 2-to-1 short. So much for being careful. Oh my God. This is what we do every single day, by the way. I said, Z, your short is there. Yeah, I know. I appreciate you, Conscious Investing. Thank you for looking out for me. But if you were short, I would take profits right now. How resilient do you think the S&P will be in comparison to the NASDAQ? I don't know, David. That's a very vague question. In terms of what? Like what timing? You mean today or what? The link for the 8 weeks in the summer, it's in the description. Look in the description of the video, and it's there. Is that double bottom not a liquidity grab? It could be, but to me, that was a clear short. I want one of those hats. Okay, here's what we're going to do. You guys want a hat? What is the fucking Fed live stream at? Let's see. The Fed live stream is at 7:20. All right, let's get this to 550 likes. And I will pick someone randomly to give you a hat. But just a heads up, you do need Instagram, because I will need you to follow me on Instagram and then hit me up when I pick you. I already want a hat. I wear it all the time. Appreciate you, Random Card Breaks. How do you like the hat? This one? It's this one, right? Blinky. Bro. You already get a hat, man. Blinky is a moderator in our academy. Blinky, of course you get a hat, bro. I'm gonna message you right after this. I didn't know you didn't have one. I thought I sent you one. I honestly thought I sent you one, man. I'll hit you up on. Blinky says no, I didn't. Wow. Brazen. Random Card Breaks. My pick with my dog. Oh, that was you. Dope. Z, what was your thinking behind calling that short on the S&P? What was my thinking? Nothing, bro. It's random. It's all random. Either that or it's magic. Like Chris Angel. No, but really, my thinking was this. I took a look at NQ, and NQ had formed this clean bear flag, right? And then broke below. So ES was actually forming a somewhat of a, you call double bottom or relative equal lows or whatever. Not an A+ short, but we have this imbalance up here. And once I saw NQ start to tank, I didn't see a path for S&P in the short term to keep going up, right? Especially the level of violence that NQ was tanking. So once we hit this imbalance, and this is a short range, but if you look at the risk to reward ratio, right? This is a, we're talking about a less than a 5-point stop for almost a 10-point, I would call it a 9-point reward, right? So it's exactly a 2-to-1 trade. This is not you can consider this a scalp if you want it. But that was my thinking, that we had this, imbalance here in the form of this huge fair value gap. We were coming up on it while NQ was tanking, and Jerome Powell was still speaking. So I figured that we get a reaction off of that fair value gap. And then plus VWAP is right here too, right? So for the S&P 500, here's what I was thinking. It would be weird to keep rallying while the S&P is tanking. And so what is the logical conclusion from this level, from this reaction, right? The logical conclusion is that if we are going to react here, we are likely going to see a drop down back to recent lows, right? So it's not enough for me. It wasn't enough of a short for me to say, oh yeah, we're going well below these lows. But it made sense to me that we were at least going back to the recent lows, because the alternative, which is, blowing past this FVG, past VWAP, while the NASDAQ is tanking the way it is, just doesn't make sense to me. So yeah. Wow, we can't get this to 500 likes. All right, I was gonna give a hat. Right, Cookie's my name. Oh, why do you have a random YouTube account? All right. Was the recent bull run artificial? What the fuck does artificial mean? It happened. What does artificial mean? Rich. No, it's not artificial. It actually happened. It wasn't a figment of your imagination. It actually happened. Go back and watch my video from yesterday. Rigged? Bro, this isn't a boxing match. There are so many factors that account for market movements, right? Institutional money, retail money, shorts, market makers selling options. There's so much that accounts for market movements, right? You can consider it all rigged if you wanted to. That doesn't mean anything. That doesn't help you trade. A bull trap? No, the S&P 500 is in a bull market. I mean, that's a hell of a bull trap, right? I think the framing from some of you has to be a bit modified, right? It was a real rally. It happened. So yeah, and now in my view, we will get a slight pullback. Blue Chip Joe, what's up? Best YouTube channel. Appreciate you. I like to rip cards open, and I wanted to start a YouTube about it. Interesting. 4 away from 500 likes. If we get to 500 likes, I will give away another hat. I'm going to give you a like, bro. Been here only a few times. All right, thank you. All right, we're at 500 likes. I want a hat. Okay, here's what you're going to do. Here's what you're going to do. Ready? I want you to put your Instagram handle in the chat, and I'm going to take a random screenshot. So put your Instagram handle in the chat. I'm going to take a random screenshot. And who I pick, message me on Instagram and I'll give you the hat. All right, ready, go. Go, 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 go. I'm going to take a screenshot. I don't have Instagram? Well, then you're priced out of this. Go. All right. Regina Slim, there you go. Send me an Instagram message. All right, you know what? Since you guys are doing this, I'm going to do another one. So keep putting it in there. So Regina, you get one, and then ready. And I'm gonna take the middle one from the screenshot. Okay. Ready. Go. All right, so Regina, hit me up on Instagram, and then the middle of this, let's go Casey Duatel is the middle one right here. So Casey Duatel and Regina, hit me up on Instagram, and I will send you guys a free hat. All right, my Instagram is in the description, by the way. So there you go. All right, I got to trade some more. Let's see if Powell is talking about anything important.
Accidentally run into reserve scarcity. Demand for reserves can be volatile, and you don't want to find yourself, as we did a few years back, suddenly finding that reserves were scarce, even though we didn't see it coming, and we then had to put more reserves into the system at a time when we didn't want to be doing that. So I think you want to have a level where we have ample reserves plus a buffer, and that'll be a % of GDP that we get down to, and we're moving in that direction pretty smartly.
Chairman Powell, realistically, how quickly can the Federal Reserve unwind its balance sheet? What's the threshold beyond which an asset sell-off by the Federal Reserve would disrupt our markets?
So we don't sell assets. What we do is we allow them to mature and passively roll off, and that's what we're doing to the tune of about $1 trillion a year. And we're in the middle of that process. Now we will, it's an empirical question. You're going to find a level that is still ample, plus a bit of a buffer, and that's how we're thinking about it.
Thank you, Mr. Chairman. I would just reiterate my concern on this issue. I fear that having the Federal Reserve backstop so much of our economy through the holding of treasuries and mortgage-backed securities is not sustainable long-term. Thank you, Chairman. I yield back.
Gentleman yields. The gentleman from New York, Mr. Horsford, or Nevada, Mr. Horsford is recognized.
I thank the chair and the ranking member for holding this important hearing, and thank you, Chair Powell, for appearing before the committee today. Before I begin, I'd like to ask permission to enter into the record editorial by the Las Vegas Sun entitled "Economy Infrastructure Thrive When Dems Have the Reins," dated June 16, 2023.
Without objection.
During this time of increased economic uncertainty, it is more important than ever that the Federal Reserve fulfills its dual mission of maximizing employment and supporting price stability. There is no doubt that it is difficult, and the needle that has to be threaded is very specific. However, the human cost is simply too great for us to get this wrong. Sometimes we need to be reminded that there are real people behind the economic data and that the actions taken by both Congress and the Fed have real consequences for everyday Americans. Everyday Americans who want to know that myself and my colleagues are dedicated to creating an economy that actually works for them, which is why I was pleased that last week the Federal Reserve decided to pause your interest rate hikes and take stock of the overall economic picture. Now, don't get me wrong, there's certainly more work ahead of us, but with 13 million jobs added since President Biden took office, we should be rooting for America to succeed and not to fail. The strength of the labor market continues despite the multiple concurrent shocks that continue to reverberate throughout the global economy. And I believe our economy remains resilient thanks to the historic investments that were included in the legislation passed last Congress and signed into law by President Biden. These beneficiaries of these investments were the people, the middle class, not special interest. The bipartisan infrastructure law is creating construction jobs and projects that will help ease supply chain challenges and ensure safer transportation for everyone. President Biden and congressional Democrats are investing in technology that will define the 21st century, components to generate solar and wind energy, semiconductors, and electric vehicles that will all be made here in America. Just last week, Treasury Secretary Yellen was before this committee and described how the transformational investments from the Inflation Reduction Act are ushering in a renaissance of domestic manufacturing. These are good-paying jobs, union jobs, that are expanding our production capacity here at home while reducing our reliance on goods imported from abroad. As I indicated in the editorial by my hometown newspaper, the Las Vegas Sun, remarks that annual investments in manufacturing construction has more than doubled its pre-pandemic levels. Furthermore, when we narrow the focus to the region, including Nevada, the U.S. Census Bureau estimates that in just 2 years, private manufacturing construction increased almost tenfold. So if we want to rebuild the American middle class, we must do so from the middle out and by investing in modern infrastructure and modern manufacturing facilities. But this does not mean that everything is improving equally. I've heard time and again from my constituents about the cost of housing being one of their biggest pain points. The Monetary Policy Report points out that housing services prices have risen a shocking 8.5% over the 12-month period ending in April, and in my district, it's even worse. So, Chair Powell, at a time where it has become increasingly difficult for working Nevadans to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a house provides. While higher rates have cooled some housing markets across the country, what do you see as the biggest remaining upward pressure on housing services, and what can we do in Congress to incentivize new home starts to hopefully moderate the imbalance between supply and demand in the housing market?
I think you're talking about largely longer run factors here, and I think there has been for some time a shortage of housing. It's harder to get lots, it's harder to get workers, and in the pandemic it had been harder to get materials and things like that. So there's certainly a need for more housing. I think during the pandemic you had people wanting to live in houses rather than downtown in apartments because of COVID. You had low rates, and so you had 2 or 3 years of very, very high price increases for housing, and now that is flattened out a lot as we've raised rates. And
Gentleman's time has expired. The gentleman from New York, Mr. Lawler.
Thank you, Mr. Chairman. Chairman Powell, You, the Fed's Vice Chairman for Supervision, and many others have indicated that the banking system is well capitalized. Bank capitalization remained robust during the COVID shock and related shutdowns of economic activity and in severe Fed stress testing. Nonetheless, the Vice Chair for Supervision wants to increase capital and other requirements on financial institutions. This will have substantial economic effects that will begin immediately while you are still focusing on bringing inflation back to the Fed's 2% target. Excessively high capital requirements will constrain credit provision to the economy, costing jobs, incomes, opportunities, and living standards. As my colleague Mr. Garbarino pointed out, a 1% increase in capital requirements could potentially reduce GDP by up to 16 basis points based on the Basel Committee literature. On January 21st, 2021, 30-year fixed-rate mortgages had an interest rate of 2.77%. Now, for the same loans, individuals are looking at a 6.69% interest rate for a 30-year fixed-rate mortgage. For the median home, valued at $436,800, the difference from less than 2.5 years ago to now equates to over $300,000 more over the course of the loan. For the median household making around $71,000 a year, that extra $10,000 a year out of pocket in mortgage costs is crushing. Some areas like my district are even harder hit due to the high cost of living and the lack of housing. Combine that with inflation at or above 4%, and these factors are taking a real toll on the average American family, including in the Hudson Valley. Now, further decreasing the availability of credit to households and businesses across the country would only likely worsen this crisis. So, Chairman, do you agree that excessively high capital levels constrain banks' lending capacity with spillover effects on jobs and living standards for Americans, and effects would begin immediately, independent of any proposed phase in timing?
I do think that, as I mentioned earlier, there is a trade-off between safety and soundness and availability of capital, and you want to get that balance right.
But respectfully, you have testified that there was more than enough capital in these banks. So where are we unsafe and unsound that we would require more capital requirements?
Well, as I mentioned, that's the question we're going to be asking as we review the proposals when they do come forward. We don't have a proposal in front of us at this point, and I think as I mentioned, any increase in the capital for the large banks would need to be justified. I don't know that there will be much in the way of capital increases proposed for banks other than the very large banks, but we'll have to see.
So you don't believe regional and community banks will face the same requirements?
Very different requirements, I would think, as they do now.
But you're not looking to increase the requirements on them?
We'll have to see what the proposals turn out to be. Honestly, they're still to some extent in motion, and once they're out, we can have lots of conversations about the specifics. But until they are, it's tough to do that.
And you'll commit to providing this committee with all such analysis before any proposals come out?
I think there will be a proposal that comes to the board sometime this summer, and the board will vote on that, and we'll obviously share whatever analysis we have.
Are you concerned that any significant increase in capital could significantly jeopardize the Fed's efforts to rein in inflation?
So the thing about capital requirements is there would be a 90-day comment period, roughly, something like that, could be in that range. And then there would be a long period of considering those, the comments that are made, and then there would be movement toward coming to an agreement about what to finalize. And after that, so that would take many months, and then you would be into a situation where there would be long phase-ins. So I don't really think capital requirements play into the near-term economic situation the way interest rate hikes do.
Chairman, according to the Bureau of Labor Statistics CPI inflation calculator, it takes $1.16 today to buy the same consumer goods and services as $1 purchased when President Biden took office in January of 21. Do you agree that outsized inflation we have seen since early 2021 has caused and continues to harm workers, retirees, and families trying to make ends meet and pay their bills?
I strongly agree with that, and that's why we are taking the measures we're taking.
Thank you.
Gentleman's time has expired. The gentleman from North Carolina, Mr. Nichols, recognized.
All right. Thanks, Chair Powell, for being here with us today. Back in 1995, I worked here in Congress as an intern for Dick Gephardt. I was in his press office, and we had.
All right. Are you in Canada? No. Why would you think I'm in Canada? I'm in California, not Canada. All right, let's see. Any last minute questions? I'm gonna go and trade with the Academy, of course. Need to do that. So already gave you guys a fire 2-for-1 trade, but now I think it's time that I go back and trade with the crew. So if you're interested in joining, check out the link in the description. Join us as we trade every single day from pre-market until after-market close. Otherwise, for those of you not in the Academy, I appreciate you guys. Thank you guys for joining. Those of you that won the hat, I already got your Instagram messages, so thank you so much for that. And yeah, thank you guys for joining me, and I look forward to doing more of this stuff. Leave a thumbs up on your way out, especially if you learned something. And for those of you that are in the for those of you that are in the Academy, I'll see you guys in a couple seconds. I'm just going to get more coffee, and then we're going to be trading. I was looking at a potential short on Tesla here, so we'll see. All right, guys, thank you guys so much for joining. Stay safe out there, traders. Peace.